Good evening, everyone, and a very warm welcome to today's session. It is my great pleasure to introduce our esteemed speaker, Dr. Darshan Thackeray. Dr. Thackeray is an ENT and head and neck surgeon practicing in Malegaon, Maharashtra. Alongside his successful medical career, he has been an active member of WealthCon for the past 7 years and has completed almost all of WealthCon courses under the guidance of Dr. Ram. At WealthCon, he has been serving as a senior guide. Please join me in giving a warm welcome to Dr. Darshan Thackeray. Sir, we are truly honored to have you with us today. Over to you, sir.
Yes, thank you for the kind introduction, and thank you everybody for joining today's meeting. So, starting with the saying, Asato ma sadgamaya, tamaso ma jyotirgamaya, which means lead me from the unreal to the real, lead me from darkness to the light. And in today's context, from ignorance to the knowledge. So, my brief introduction, I am an ENT surgeon from Maharashtra. I'm practicing at Malegaon. I have been associated with WealthCon since last 8 years. Few words about our mentor, Dr. Ram sir. He needs no introduction, but for those who are new to WealthCon, he is the WealthCon founder, a radiologist practicing in Mumbai with glorious financial profile and 20 years of experience in investing and trading. And he has a unique blend of his academic knowledge, practical market exposure, and zeal to teach. He has taught more than 95,000 doctors across India and the globe, including myself. So now WealthCon, for those who are new, it is an educational platform run by doctors for the doctors to create financial awareness amongst the doctors. It does not provide investment tips, portfolio management services, or any recommendations. So we are a purely educational platform, and we follow all the SEBI educational guidelines as well. Now, before starting with our journey towards financial independence, here is a small advice. Here at WealthCon, we follow the SWAN principle. So be a SWAN, take whatever is suitable to you and discard the rest. So it is advised to be a student and not a judge, because if we are a student, we can learn the maximum. So before starting, I will share my journey today. When I was starting my private practice, I decided to take a small loan of around 9 lakh rupees for buying some microscopes or endoscopy setups. Actually, the purpose was to get the experience as well as to improve the credit score for future bigger loans. Now, the banks asked me for 3 years ITR. I had not filed any ITR till then. So I went to the CA and got my 2 years ITR filed with some late fees. While I had to wait for the few months, 4 to 6 months, till I filed my third ITR. Secondly, after a few years of practice, the income was accumulating in the bank accounts. Then one day my CA said to me that you should do something with this bulb. I really had no clue about what he was saying and what I really should do with that money. I am grateful that WealthCon happened to me at the same year, at the same time, and I got all my answers. Few of the our colleagues get trapped in the products like ULIP policies. They are sold by agents. They do not provide adequate insurance, neither give adequate returns. So we, being doctors and the cream of the society, but we are so ignorant regarding our finances, with no knowledge of taxation, no knowledge of insurance, no knowledge of investment or loans. So basically, we are here today to learn systematic way of managing life and money to begin our journey of financial education, become self-reliant, to begin journey of investing and wealth creation. So what we do not do at WealthCon, we don't give investment advice, tips of stocks and mutual funds. We educate you. We don't give you ready-made fish, but we teach you the technique of fishing. We don't believe in intraday trading and satta. Here at WealthCon, we condemn that. We are not going to provide you the get rich quick kind of schemes here. So now, if we look at the game of financial independence, the ultimate goal is financial freedom. And this ultimate goal has a lot of ladders and lot of snakes in between. Now we need to understand that a lot of expenses like loans, EMIs, inflating prices, necessary expenses, high taxes, these are all going to pull us down. And we need to understand that, yes, there are certain ladders as well, which are going to help us, like financial discipline, savings, investments, insurance, tax saving. These are some of the ladders that are going to help us achieve our goal of financial freedom. So we need to be aware of all the snakes as well as all the ladders in this game if you want to win the game. So when we want to start the financial education, what should we learn? So there is income management, wealth management, life management as well. So why to learn this? So as to become self-reliant in finance, because we cannot outsource the finance. So when to learn? The earliest is the best. So today is the best day. Start learning today itself. And where to learn? WealthCon is the best platform for doctors. As I have said, more than 95,000 doctors all across the globe have been trained by WealthCon and are benefited immensely by WealthCon. Now, this is the journey of any person, for that matter, a doctor as well. First 30 years, we are going to spend in our education. Middle 30 years, we are going to spend in our careers. And the later part, after 60, we are going to spend in retirement spendings, wealth protection, and travel and other recreational activities. Now, as you can see, the wealth creation part that happens in the middle 30 years, and that is what probably most of us are in. These middle 30 years, so it's very important for us to know that this wealth creation is going to happen in these 30 years, and we have to be aware how to do it before that time is lost. So let's start with the personal finance. I will give you a general idea how we are going to proceed. We are going to learn the personal finance under these 6 headings. You can remember this mnemonic, I split. And this I means the income. And we are going to actually split this income in the next 5 parts, that is split. So the pizza of this income gets divided into 5 parts and is eaten up by the next 5 headings, that is spending, protection, loan, investment, and taxation. Now, where your income goes first and what should be the sequence? So this is the key principle in finance. It should be earning, savings, and then spending, and not the other way around, like earning first, then spending, and whatever remains goes to savings. This is wrong. So consider if you earn, let's say, 100 rupees of income. So not more than 25 rupees should go to your loan, and at least 25 rupees should go to the investment first, and then 10 rupees can go towards your taxes, and around 40 rupees remain, out of which you can pay towards your insurance and other necessary expenses. And whatever remains, that will go to the spendings. So this is how our finances on our personal level are going to be. So let's get to know about them one by one. So now let's understand about income first. The income can be, there can be certain types of income like active incomes and passive incomes. Now, active incomes are like jobs. If you are working at some place, or if you are self-employed professional like a consultant, or if you are running the self-operating business, you can run an OPD or your hospital also. And there can be passive incomes. The passive income is going to come from investments we make, the assets we create. They are going to give us the passive income. And that is going to be in the form of capital gains after selling your investments, rents coming from the real estate property, then different equity products can give interest, whereas debt or equity products can give dividends. So a lot of passive incomes can be there. So now we are probably in a situation where increasing the active income is getting challenging day by day. Of course, that should be the first goal of each and every professional, but that is going to be challenging day by day. But we have to understand that we have to increase our passive income. And that increasing passive income is very, very important. And that is going to determine how your financial journey is going to be. Now, you must have heard the story of a grasshopper and an ant, where the ant is saving for the winters and the grasshopper, he is just careless and probably following the philosophy of we just live once. And he ends up very badly. While as the ant is saving for the winters, so it made her life very easy. So saving and investment is very important. But sometimes we forget about this basic principle and we fail to actually put it into practice. Now we will also have to learn about something called as assets and liabilities. Now these words like financial jargons, and you may feel like this is like a economics class of something, but actually it's very simple. Simply speaking, assets are something which put money in your pocket, while liabilities are something that take out money out of your pocket. That's it. So the home in which we are living is not actually our asset. It is going to give us, is it going to give us money? No. So until we sell it, it is not going to give us money. My car is a depreciating asset, or it's not an asset, it's a liability actually, because I have to keep spending on it. Maybe it's a maintenance and other lot of things. So it's not an asset, but liability. But my investments are going to be my asset. So I will give you a funny example to better remember this asset and liability. Let's say a hen, which we are going to buy, will be an asset for us, as it is going to give us eggs. It is going to give us a recurring return. But the dog which we have bought is going to need a lot of money or a lot of expenses and going to take money out of our pockets. So it's funny, but very simple example to make you remember what is asset and what is liability. So in our financing journey, we have to remember that we have to build assets and reduce our liabilities. So that should be our prime goal. Now we have to understand how to proceed with our expenses. So how are you going to spend when it comes to spending? We categorize spending expenses into two categories. One is the products of need, and other is the products of prestige. So a lot of products we buy are the products we don't need, but we buy them because we want to show off or it suits our lifestyle. So any kind of expensive car, expensive electronic gadgets, mobile phones, expensive jewelry, these are all basically the products of prestige. They are not the products of need. Needs are very simple and very limited items. These are our day-to-day bills, our health expenses, our education or living expenses. Now, many people have the philosophy like that grasshopper, like Zindagi na milegi dobara, or you only live once and whatever you earn, just spend it and enjoy. But the problem with this is that we are not prepared for the winters. So probably what happened with the grasshopper is going to happen with us. So we have to be cautious and we have to be smart. We have to be intelligent like the ant, and we have to save something for the future, and that is what is important. So if we reduce our expenses on the products of prestige, we can actually save more, and if we can save more, we can invest more. So before we spend anything, we need to ask a few simple questions. Is it an essential expense? If it is an essential expense, then yes, mostly it is a product of need. The next question is, will it improve my quality of life? If yes, then probably it's a product of need. Can I afford it without loan? try to see that most of the things you want to buy are not on loan. When you buy things on loan, it's like use today and pay later. This is something like a debt trap, and that we are going to look or see how it is bad. So next question is, will it be benefiting me in the long run? So what does it mean? It means that if I'm taking a loan for my education, so obviously it is going to empower me, and then with that education, I'm going to progress in life. So probably I'm going to be financially better. So this can be a good expense. Even if it comes using an educational loan, it's fine. So if I am investing in my business, probably that business is going to give me a higher returns, then it is going to be beneficial. If I am spending in all such situations, probably these are the products of need. But if the answer comes as no, then probably they are the products of prestige. And I am buying them for show off. That show off can be at actual or online or different kinds of situations we see around us. Now, when we talk about spending, we should also talk about what are our defenses. So, Rahul Dravid, he was also called as the wall, who had a great defense. So we also need to have some defense from a lot of bouncers, yorkers, and googlies in life. And what are these bouncers? These are death, disability, critical illnesses, and different kinds of liabilities that we. And we need to be prepared for this. And unless we are prepared for probably it is going to drain our investments or our capital. So this is something very bad. So quickly, we will see an example. Dr. Raju, he's a 35 years old doctor with two kids, 7 years old and 4 years old, and wife was a housemaker. So he earns 3 lakhs a month, and he spends around 1 lakh on his household expenses, 1 lakh on home EMI, 30,000 on car loan, and around 70,000 rupees a month was his savings. Now his total liabilities, if we see, are going to be future liabilities and current liabilities. Now, in case of his untimely death of Dr. Raju, then what's gonna happen to his family? So that is something which is very important. So let's see what are his liabilities. So house loan is still 1 crore balance. The car loan is around 20 lakhs balance. Yearly, his family is going to need 1 lakh a month. So around 12 lakhs per year with 6% appreciation yearly. That is because we know that there is something called as inflation, where the prices of the things go on increasing year on year. And education funds of his kids, they are going to be needed after, let's say, 10 or 12 years. Now, what he had done, he had purchased a term insurance plan, which is a pure life insurance plan, and where he calculated that how much should be the sum assured. So he applied a very simple logic. As 20 years multiplied by his annual income 3 lakhs, multiplied by 12 months, that comes around 7.2 crores. So due to this unfortunate event, he is gone, and now his family has got 7.2 crores as sum insured. So now this is the tax-free income. So his wife paid around 1.2 crores upfront for the home loan and car loan. And the raised 6 crore rupees investment was done in the debt instruments. Now, debt instrument is something which is good to protect your investment. It is not going to erode your investment. The returns might be low, but it is safe investment, low risk investment. And we assume that inflation rate in the future is going to be around 6%. So if we do the maths, we can understand that for next 20 years, they will keep getting 1 lakh per month as per today's amount. But it will also increase later in future, equivalent money for survival, as they can have very good, decent life. Plus, they may need some educational funds in the future that can also be satisfied. So this is something which is important, and we need to understand that term insurance is very important in life. Now we understand that literate people call the insurance as an expense. but it is the necessary expense. If you go for the term insurance, health insurance, indemnity insurance, car insurance, yes, it is necessary expense. But many people look at the insurance as tax saving tool, or they link it with the investment, just like unit plans, and that is something which is a problem. Now coming to the loans. Loans is a modern day slavery as called by Dr. Ramsar. So ancient slavery was different, and today's slavery is debt slavery. So we have to understand that we should not be falling into such traps. Whenever we are taking debt, we should be thoughtful. So how can we think about it to understand that there are going to be some good loans as well as some bad loans? The good loans are which are going to buy your asset, like education, hospital, some machine. These are the good loans. But bad loans are consumer goods. You are just buying cars, expensive gadgets. You are taking personal loans. You are using a credit card, and a lot of interest you are going to pay on that. So earn first and spend later is an important policy. If you do the reverse, that is spend first and save later, that will pull you in the debt trap, and it will be really bad as far as your financial journey is concerned. So now coming down to something called as inflation. What is inflation? Inflation is the prices of everything, every commodity, anything we use. They go on increasing year on year. And we say that average inflation in India is around 6% for routine commodities. But special commodities or luxury items, they may have the inflation rate more than that, maybe around 10 or 12%. And that is something easy to understand. So in year 2000, let's say 100 rupees could buy you around 10 cups of tea. But now in 2026, you could buy only 3 cups. Likewise, milk was around 14 rupees a liter, but now it is 50 rupees a liter. Same for petrol. So prices are going to go up, and this is going to erode your wealth. And this is something which is good to understand. So this is what inflation is. Inflation is the snake, and it causes erosion of one's wealth and income. Every year the prices go on increasing. So we saw the game of ladder, and this is the biggest snake in that game. And we heard this song long back. सैया तो खूब ही कमात है, महंगाई डायन खाए जात. So महंगाई is the inflation that kills our income, and that is something which pushes many people down in their financial journey. So what do we people understand and the need to invest? We need to save and then invest, and then people are found by some agents, and these agents tell them that you invest in these plans, which are insurance plus investment plus tax saving plans, and mostly this is what something happens. But these are the ignorance plans, because these plans come out of our financial ignorance. Now there are two components in this. We can just quickly see in this, if one person invests in this ignorance plan, let's say 1.2 lakhs per year, he's going to make around 62 lakhs after 30 years. But if he's investing the same amount in a good average risk equity with, let's say, 12% returns, like Nifty returns are around 12%. So he's going to get around 2.9 crores in the next 30 years. So you can see the difference. Secondly, this second person is going to get a very, very minuscule amount of term insurance, the first one. But we saw that the term insurance Dr. Raju bought was 7.2 crores. So sometime our actual liabilities can be very, very high, the current and future liabilities. So somebody who is going to buy ignorance plan will get very, very minuscule amount of sum insured. But if we actually choose a very simple term insurance along with the investments in mutual funds, probably we are going to do better. So who we say no to these ignorance plans, and so you should know that we don't want to do that. And then we'll see what we want to do. So investments in these different classes, there are 4 classes of for investment. We call them as GRED, GRED. So that is gold, real estate, equity, and debt. Gold, we all know. How can we buy gold? We can buy physical gold. We can buy gold ETFs like gold bees. We can buy something called as SGBs, that is sovereign gold bonds. Now people say that, okay, buying gold jewelry is it an investment? I would say no, it is not. Because when we are buying gold jewelry, what happens is there is a lot of making charge, which is primarily eroding the value of that gold. So if you want to do investment in gold, it should be in the form of gold coins, gold bars, or something like that. Gold jewelry is for use. It's not an investment. So we need to understand that investment and usage are 2 different things. Real estate, obviously we say that primary home, which we are staying in, it is not our investment. So it is not an asset, okay? So when we are talking about real estate investment, it is apart from your residential house, any other land, any other house, any other commercial property you are buying, that will be your real estate investment. Now, equity, we all know that stock market is something, many people are really very worried when this word of stock market comes in. But we have to understand that there can be different ways to invest in the stock market. One can directly do the investment in the stock market by directly buying shares of certain company. And another way can be index investing, which is like ETFs. So these are exchange traded funds which invest your money in different companies, and that reduces the risk. Others can be mutual funds, so they can be good and they are necessary. Different debt products like fixed deposit is one of the debt product. There can be liquid funds, there can be G-Sec bonds, and these are all important. They don't produce high returns, but they produce high safety. Fixed deposit is sometimes the only instrument that many people do have in their as their investment, which is totally bad. Many times, real estate is the only investment people do. So, whenever they are doing their investments, or sometimes gold is the only investment. So many times people rely on only one asset class, and that is something which is really, really not correct. We have to understand that these all 4 asset classes are important, and we say that the distribution of the money which you will put in all these 4 asset classes, that can be something, roughly around, now if you are 40 years old, then 10% in gold, 40% in real estate, so 40% in equity, and 10% in debt. The proportion changes as your proportion may reduce. So this is like, a single asset class cannot help you reach your goal. So something which is important. So we say this is 40% proportion in equity and real estate, and 10% in gold and debt. So now when we come to investing, we understand that investing is a provision for future spending. And we also need to understand that this investment also has to be smart. We cannot, see just big dreams and have no preparation and end up doing something foolish. So we need to be literate in finance. We need to learn, we need to read, we need to understand that what are these different products, how are we going to invest, what are the pros and cons. So there has to be a systemic strategic way of investing. Now, as we say that there are different questions which we have to answer. So what to buy? So, as we said, GRE. So these are the 4 products that are there. So why to buy? because every product is going to behave differently. The gold will have very lumpy returns. So, last year gold was suddenly gave very high returns, but for many years gold remained stagnant. Then equity may have high returns, but it may have high drawdowns also. Prices may suddenly move very high, but they can fall down also. Debt will steady return, but very slow return, very low return. Now, real estate will need a very big chunk of money to be invested. So, every product have its pros and cons. So we need to study them in depth and now when to buy. So how shall we go ahead with the investment? So shall we be doing a SIP, what do we call it as systematic investment plan? Every month putting some money in some asset without thinking of what is its price and how it is performing. Where the stock market is going and something like that. Or whenever there is some correction, whenever some asset falls down, then at that lower price, we are going to add some more. So that is deep buying. So there can be different strategies that we can follow. Similarly, we should also be knowing that when I'm buying something, when I should exit, when should I sell the product? See, buy and sell only then we can make profit. Only buying doesn't make profit. Only buying will give you what we call as notional profit, but actually you have not received any money in your account. So sometimes you may also have to exit. So how much to buy? What quantity should one buy? How much money we should invest? Then where to buy? Which platform? Which broker platform? So all these are the logistic questions. So while being part of WealthCon, you all will be enlightened with all these in real details. So I will not have to go into a lot of in these details, but I just want to make you understand that these are the things which are very very important and we should know. So there will be some generic products like stocks, some bonds, gold, real estate, debt products. So there will be some companies or investment firms. They are going to, give you some package. These products are into something like mutual funds, gold ETFs, etc. So every product can have their pros and cons also. But what should we understand is what should we stay away from? We should be staying away from something called as regular plans in mutual funds. So mutual funds, say this is correct, but it comes with riders. So that means if there are some regular plans, probably there will be some agent involved and he takes away a lot of chunk of your money. So we encourage everybody in WealthCon to go for the direct mutual funds and not the regular ones. So without having any agent in between, because you are going to lose a lot of money on that. Similarly, the unique plans or the ignorance plans, the Ponzi schemes, multi-level marketing, unregulated products, I think these are all we should be staying away from. So anybody who promises you returns like 30% returns or double money in a year or so, I think they are all basically frauds. So we should be staying away from that also. So the moment we have to understand what all products we should buy, the same moment we should also need to understand that what all we need to be staying away from. So as we said, there will be different assets. We are looking at let's say gold or real estate or debt products. Then we can have intra-asset diversification also. So just the way we saw that GRED, this is an inter-asset diversification. So there can be intra-asset diversification also. What does it mean? It means we can also diversify in the asset. Like when you are investing in the gold, you can buy some gold bonds, you can invest some money in the gold bees and some money in the physical gold also, like something like that. This applies to all the other asset classes also. So when we are buying something for whenever investment comes in, the main first question many of us ask is kitna dega? Kitna dega means how much is the return will it give? But that should be the last question actually. We should be looking a lot of other things first. So what are those things? So what is the cost when I am buying something? What is the cost I am paying to get the entry? Not the price of that asset, but just to buy that asset, we need to pay something. So I am paying some cost. For example, to buy gold, I am paying GST to the government. So that GST is paid to the government. There is no gold worth of that GST amount that is coming to me, right? So it's the cost which I am paying. Now, what is the holding cost? Now, if I am holding the gold, I am probably afraid to hold the gold in my house. So probably I will have a bank locker and I am paying for the bank some amount of money. And there will be some holding price also. Then there is something called as exit cost. Exit cost is different. For example, for some mutual funds, they will charge you some exit cost. They will deduct some amount when you are going to sell those mutual funds. Secondly, we know that buy gold price and the sell gold price. So when you go to buy from the jeweler and sell to the jeweler, the cost is different. The buy cost is going to be higher and the sale price is going to be lower. So there can be a lot of hidden cost that we are going to pay. Then there are going to be some taxes whenever we buy something and then we sell. We are going to create some capital gain. When you buy and sell at a higher price, we get capital gain. So government is going to tax us on that. It can be short-term capital gain tax or a long-term capital gain tax, depending upon the duration you are holding the asset. So there will be different taxation for this. So we have to pay taxes. Then there is something called as liquidity. So what is liquidity? Liquidity means when I go to sell something, are there sufficient amount of buyers whom I'm going to sell? The liquidity is going to be very important. This is going to be challenging in certain asset classes. For example, real estate. If I want to sell my flat tomorrow, is it going to happen over a few minutes? But if I want to sell my shares, yes, it can be. I can sell my shares within next 1 minute. So there are going to be a lot of variations in different asset classes, and we need to know them. So what is drawdown? The drawdown means you have bought a certain asset at a certain price. The price suddenly goes down, and these drawdowns are going to be common in equity. But over the long run, these do not matter much. So that's why when you are going to invest in the equity, that means in the stocks or on the share market, then your horizon should be holding period should be more than 7 years. So for short horizon, 6 months to 1 year, equity that is stocks is not something that is going to be helpful for you. Then there is volatility. Volatility is everyday prices keep changing, and this we need to understand that certain asset classes have certain patterns of behavior, and then we need to calculate the returns also. So the returns can be, it's like even you're going to do one time investment, then it can be calculated with the help of something called as CAGR, compound annualized growth returns. Or if it is the investment like SIP, where you are investing the amount every month in a certain interval, then it can be calculated with the help of XIRR. Then there is rolling return and many other things. So after cost, I have liquidity risk. Then we are coming to the returns, and then we are going to make the decision. So see, it looks very difficult, but actually it is not. When we start doing this, it is very simple. I want to make it clear that it's not just to look at the returns of a certain product, but we need to look at other parameters also before we invest in that. So now, as we know that all the assets in Indian markets, the Nifty is going up, gold prices are going up. If you are putting money in the government bonds or FD, but it has a different behavior. But understand that longer time we stay invested, the better money we make. So what is very important, that takes us to what is called as power of compounding. So let's understand the power of compounding. So this is an example. So if we make a 50,000 investment and that we are doing religiously for a period of 10 years monthly. So we are going to make around 1 crore over a period of 10 years. So for the next 10 years, addition is going to be almost 3.3 crores. So it's not like 1 crore in the first 10 years and another 1 crore in the next 10 years. It doesn't happen like that. The first 10 years is giving you 1 crore. The next 10 years are going to give you 3.3 crores. And the next 10 years are not again giving you 3.3 crores. It's going to give you a lot more than that and totaling up to, let's say, 12.3 lakh, 3 crores. And that is the beauty of power of compound. So longer you stay invested, very exponentially higher amount of money or returns you will be able to generate. So it is also important to understand that the compounding of money which you are investing in is important, and but the amount of time we are staying invested is also important. So just look at these two examples. One person is investing 50,000 with 12% returns for 15 years to generate 1.13 crores of return. And see the another person, he's investing just 15 rupees a month. So far less than the first one, 1/3 of the amount of the first person. So he's going to also get 12% return, but he has invested it for double amount of time, that is 30 years. So he could generate around 1.48 crores, so much higher than the first person. So only amount which we are investing is not important, and the amount of time we remain invested is also important. Now a little bit about taxation, because we can understand that tax is inevitable. Dr. Ramsar says death and taxes are absolutely inevitable, and paying tax to the government is the highest form of charity one can do, which we are doing. And now there is something which is called as a new tax regime, which has this slab rate. You don't need to go into very detail, but you need to just understand that every 4 lakh slab income, the tax percent increased by 5%. And the maximum tax bracket is 30%. So of course, there are certain situations where tax goes above this 30%, but we are not going into that right now. So many people do cash generation, they don't show income. And that is the way they think they are saving the taxes. But that is absolutely wrong. Because one is you are evading the tax, that is illegal. And second one, that you are not creating a post-tax income, which is available to you, invest and buy assets. And that is something very important. Because what are you going to do with that cash? It is that we are going to spend it. It's an expense. It is not going to buy yourself, but an asset. But when you are paying taxes, you get the post-tax income. So now coming to the philosophy of know thyself, that means you first should know yourself well. Why you are doing this? So before you jump into the waters, you should know what are your strengths and what are your weaknesses. That's something which is important, because investors and instruments together become an investment. So it is not just the investor or not just the instrument which forms the investment. So it is not only one, but both together. So someone may ask, just tell me what is the best thing I should be doing. So it is not like that. The best is not always possible. It is very subject specific. That person's age, his risk appetite, etc. A lot of things come into play. So we can call these by the mnemonic of target. It's very simple to remember. So what is it? It is T for time horizon. That many times it is 3 years. Let's say it is 3 years. Then I will say that no, stock market is not good for me. I will look for something different. Then I will say if my time horizon is 10 to 15 years, then probably equity might help. Then what is my age? If I'm 70 years, probably my primary goal is my capital protection. If I'm 30 years old, my risk appetite will be higher. So Next is what is my goal. If it is my retirement corpus, child education, for marriage or whatever, then what are my expertise? Am I expert in this? How much knowledge do I have? If not, then I will upgrade myself. But today, what is the level of my knowledge? How much time can I dedicate? Can I dedicate 10 minutes a day or 10 minutes a week? Or depending upon that, we need to understand that what path we are going to choose. And that is something which is important. So there are certain don'ts which we follow before coming to the last slide. So we should never outsource the financial decisions to someone else. We should never invest in the unregulated and fancy products. We should never invest on tips, intraday, stop loss trading, or satta. We discourage it at Wealthcon. We don't allow this to happen in the Wealthcon platforms. Then never expect more than 30% annual return on investment. When anybody promising you high returns like double the money in 1 year or 2 years or more than 30% of annual return, that is fraud, and never do that. Then never transfer your funds to unknown person to avoid frauds and scams. So it is very, very important. We have seen a lot of doctors and a lot of educated people like us getting into these traps. They transfer their money to somebody else's account so that that person will invest their money. And this is illegal. This cannot happen. And please, please never fall into such traps and scams. It is very important. They never borrow money to invest in the stock market and buy consumer goods. So money mostly is going to satisfy most of the things you need. So wealthy people might have struggled a lot to create their wealth. So please don't help them. Never buy ignorance plans for investment. Never invest in MLM schemes proposed by friends and relatives, and never stop learning. So coming to the last slide of the day, the take home messages. So we have to be self-reliant. You should start learning and take actions. Only knowledge without action is just entertainment. So you have to open a demat account. You have to clear your debts. Then we should become loan free as early as possible. So we should avoid the ignorance plans, and we should plan our taxes, and we should plan for our long term financial planning. So thank you very much, all of you, for attending this webinar today. And those who are part of WealthCon, you know that there we have a broadcast channel. Those who are new to join, you can scan this QR code, or you can just note this number, and or you can take the screenshot, send hi to the admin on WhatsApp, and the admin will contact you, and you will be getting added to the WealthCon broadcast channel. So this is completely free channel. This is a free platform run by doctors for the doctors. There is no profiteering situation here, and this is a way of giving back to our community the knowledge that we have got from the WealthCon. We want to pass it on to the next generation of doctors. So if you have any questions, you can post it in the chat box. So any questions? There is a question, uh, GRED expected distribution at age 3. Okay, 38. Yeah. So 38 to 40 means you are in the wealth creation bracket. So your GRD distribution can be 10, 40, 40, 10, means 10% in gold, 10% in debt, 40% in equity, and 40% in real estate, as I stated during the presentation. See, when your age increases, your priority shifts towards wealth protection, not wealth creation. Whatever wealth you are creating in these mid 30 years, you need to protect them uh, after the 60 years. So that time you can shift your chunk more into the debt products, which are less risk, and you can reduce your exposure to equity. Yes, the question is whether minors can start investing and how. Some brokers provide this facility for minor accounts, like it is there in Zerodha, but that will come under the guardians only. So basically, it is your money only, and you can manage that account. These miners, WealthCon has started a group, and the meetings are conducted there. WealthCon guides and senior guides conduct Zoom meetings for the children of WealthConians. So that is also a very nice activity we are running, and your specific age groups children can also join there. Yes, somebody has said that Grow and Zerodha are direct investment apps. Yes, right, absolutely. These are all the broker platforms where you can directly invest into the stock markets. The difference between these brokers are some are the discount brokerage firms like Zerodha and Go, and some are professional brokerage firms which cost you more, and they also provide the portfolio management services. So next question is when to exit from mutual funds. See now, this is your target specific. Uh, what was your aim while you were started investing in the mutual funds? Like if you have kept some funds for your children education or your marriage of your children. So at that particular time horizon, you can redeem your mutual funds. Or if it is long-term investment, if you don't need to withdraw them, then you can carry them for longer durations. Any other question? Okay, the next question is minor investment saving over top tax or not? No, actually, the miners investments and profits will be clubbed with your taxation, the parents' taxations. So there are certain schemes for the miners from government, like let's say PPA for Sukanya Samriddhi Yojana or fixed deposits. In these cases, there are certain chances of saving the taxes. Otherwise, the in capital markets, there is no scope for that. Anything else? I think we are done with the questions. So, admins, you can take over.
So, if you want, we can wait for 1 more minute. If there will be no query, we can wind up. Okay?
Sure, ma'am.
Sure, sir. Sir, I guess there is no more question, so we can wind up.
Okay.
Okay? Thank you, sir.